December 29th, 2025, Friday afternoon, the markets are closed. CME Group issues advisory. Number 25-393. By Monday morning, silver drops from $84 to $73, 12%, in minutes. They called it a margin adjustment. But what happened in those 72 hours wasn't risk management, it was a kill switch. And the target wasn't just silver, it was the entire futures market. Let's establish the facts. On December 26th, 2025, CME Advisory 25-393 goes live. Silver futures margins increase from $22,000 per contract to $25,000, a 13.6% hike. The second increase in 14 days. This isn't standard procedure. Between December 12th and December 31st, the CME raised silver margins 3 separate times. In less than 3 weeks, the cost to hold a single silver contract tripled compared to early 2025. Now here's what they won't tell you. On December 29th, silver hit an all-time high of $83.90 per ounce. The metal had surged 147% in a single year. Solar demand alone consumed 200 million ounces in 2025. Electric vehicles, AI data centers, semiconductor manufacturing. Industrial demand was over 700 million ounces. Mine production? Flat. The global deficit hit 300 million ounces. Physical silver was vanishing. And then the CME changed the rules. Within 72 hours, silver crashed to $73.72. Leveraged long positions were liquidated. Retail traders wiped out. Institutions forced to sell. The narrative? Market volatility required adequate collateral coverage. But if you look at the Shanghai Futures Exchange, physical premiums didn't drop, they went up. While paper silver collapsed in New York, real metal in Asia commanded 12% premiums. 2 markets, 2 prices. One of them is lying. January 1st, 2026. Another clock strikes midnight. China's Ministry of Commerce officially implements export restrictions on silver. Not a ban, a licensing system. Only 44 companies approved for 2026 and 2027. Requirements: 80 tons of annual production capacity, $30 million in credit lines, proven export records from 2022 to 2024. Translation: if you're not state approved, you're not exporting. China controls 15% of global mine production. But here's the critical detail most analysts miss. China refines 70% of the world's silver supply. That's the choke point. Between January and November 2025, China exported 4,600 tons of refined silver. They imported 220 tons, net exporter. But their domestic consumption is exploding. Photovoltaic manufacturing, 5G infrastructure, advanced semiconductors, Shanghai futures. Exchange inventories hit the lowest level since 2015, below 500 tons. And now, Beijing reclassifies silver as a dual-use strategic material, the same category as gallium and germanium. Elon Musk tweeted about it. This is not good. Silver is needed in many industrial processes. He's right, but it's worse than he thinks. 2 buyers approached Kuya Silver in late December, offering $8 to $10 above spot price for physical delivery. In Dubai, 1-ounce silver coins were selling for $99.93. COMEX, March 2026. Contracts closed at $72, $27 spread. That's not a premium, that's a different market. The bifurcation is complete. Paper silver trades in New York and London, physical silver trades in Shanghai, Hong Kong, and Dubai, and the West just lost price discovery. November 28th, 2025. COMEX experiences a cooling system failure. Trading halts for 11 hours, silver surges 4% to a then record $55.66. But that's not the story. The story is what happened in December. 60% of COMEX registered silver inventory claimed for physical delivery in 4 days. Let me repeat that. 4 trading days, 60% gone. As of January 2026, COMEX registered inventories sit at 415 million ounces, down from 449 million in November. 34 million ounces withdrawn in 8 weeks, and the delivery requests keep coming. January 7th, data shows open interest spiking during a non-primary delivery month. That never happens. Futures markets are for hedging, not physical acquisition, unless the paper system is breaking. Analyst David Morgan put it bluntly. The ratio of paper silver contracts to real physical ounces is 356 to 1. 356 paper claims for every real ounce. And now people want delivery. Silver went into backwardation in late December. Spot prices higher than futures. That signals one thing. Immediate demand exceeds available supply. The market is screaming for physical metal, but the vaults are running dry. 29 million ounces left COMEX in October alone, shipped to London to cover shortages there. because the London Bullion Market Association was bleeding out. Their free-floating stockpile dropped from 305 million ounces to 125 million. 180 million ounces gone. When vaults empty, currencies weaken, and markets rely on paper, I-O-U-S, only physical metal matters, and there isn't enough to go around. March 27th, 1980, Silver Thursday, the Hunt brothers, Nelson, William, and Lamar, tried to corner the silver market. They accumulated over 100 million ounces of physical silver, controlled 69% of COMEX futures positions. The price hit $50. Then COMEX changed the rules. Silver Rule 7, heavy restrictions on margin purchases, sell-only orders. Within 4 days, silver dropped 50%. The Hunts couldn't meet margin calls. They lost over $1 billion. The Federal Reserve arranged a bailout, and the narrative was set. Market manipulation. But here's what they don't tell you. Gold peaked the same day, January 21st, 1980, $850 per ounce. Platinum and palladium hit record highs within weeks. All four precious metals surged simultaneously. Was that the Hunt brothers too? Jeffrey Christian of CPM Group, a respected metals analyst, says the Hunts contributed maybe 50 to 75 cents to the silver price, not $50. The real driver? Inflation, currency collapse, investors fleeing paper. The U.S. came dangerously close to losing control of the dollar in January 1980. Mike Maloney's research shows that ordinary investors shifted from gold to silver because silver was more affordable. The Hunt brothers were convenient scapegoats. Silver was easier to manipulate than gold. Regulatory intervention in silver sent a message to gold traders: don't test the system. Now, fast forward to December 2025. Silver surges 147%, hits $84, and the CME raises margins 3 times in 3 weeks. Advisory 2 5-393, Advisory 25-399. Forced liquidations, leveraged longs crushed, silver drops to $73. Sound familiar? They're calling it Silver Thursday 2.0. But there's a critical difference. In 1980, it was 2 billionaires. In 2025, it's global industrial demand. Solar manufacturers, EV producers, AI infrastructure. These buyers don't stop because price goes up. They need the metal, and the deficit is structural. 5 consecutive years of supply shortages. 820 million ounces cumulative deficit from 2021 to 2025. That's an entire year of mine production. Gone. The CME can raise margins, they can liquidate speculators, but they can't print silver. Let's talk about where this goes. Robert Kiyosaki tweeted in late December, silver breaks $80, 200 next. Analysts at FX Empire see $100 as the first major milestone, then 200, then 300 by end of decade. CoinCodex algorithmic forecast predicts silver reaching $348 by end of 2026. Long forecast projects $162 by December 2026. Gold Silver's Alan Hibbard says he wouldn't be surprised to see silver increase by over $100 per ounce to $175 plus. These aren't fringe predictions. They're based on structural fundamentals. Here's why $300 isn't crazy. 1. Supply deficit continues. Global demand 1.2 billion ounces in 2025. Mine supply 1.03 billion ounces. 160 to 200 million ounce deficit. 2. Industrial demand accelerating. Solar photovoltaic alone projected to consume even more in 2026. EVs require 25 to 50 grams per vehicle. Automotive silver demand expected to triple by 2030. 3. China export restrictions. 44 approved companies. 7 to 10% of global supply now controlled. Tightening an already deficit market. 4. COMEX vault drain. 415 million ounces registered, but 356 paper claims for every ounce. When delivery demands spike, the math breaks. 5. Paper physical divergence. Dubai premiums $27 over COMEX. Shanghai 12% premium. Physical market decoupling from futures. 6. Investment demand awakening. Gold-silver ratio hit record highs in April 2025. Silver historically outperforms gold percentage-wise. If gold hits 5,000, silver math gets explosive. The setup is unprecedented, a commodity in structural deficit, with industrial demand that can't be substituted, facing export restrictions from the dominant refiner, while paper markets run out of deliverable inventory. If even 5% of paper contract holders demand physical delivery, the system collapses. And silver revalues, not to 50, not to 100, to whatever clears the market. $300? That's conservative. So why did the CME really raise margins? Let's decode this. Major bullion banks have been short silver for years. As of December 2025, estimated 725 million ounces short across COMEX and LBMA. When silver hit $84, those shorts were facing catastrophic losses. Covering 725 million ounces at those prices? Impossible. The metal doesn't exist. So what do? You change the rules. CME Advisory 25-393 wasn't risk management. It was a coordinated effort to collapse the price and give shorts breathing room. Here's the timeline. December 26th, Advisory 2 5-393 issued. December 29th, silver peaks at $84. December 30th, another margin hike announced. December 31st, Advisory 25-399 effective. January 1st, China export restrictions begin. Within 1 week, silver drops 15%, retail longs liquidated, institutional positions unwound, and physical buyers in Asia step in at lower prices. The Western paper market just transferred wealth to Eastern physical buyers. The CME margin hikes serve three purposes. 1. Protect short-side institutions from delivery obligations they cannot fulfill. 2. Shake out leveraged speculators to reduce open interest. 3. Create temporary price suppression before China's export restrictions make physical silver even scarcer. It's a bailout for bullion banks, disguised as market stability, the same playbook as 1980, but this time, the physical market is too tight. Margins can liquidate traders, but they can't create inventory. And when China stops exporting, when COMEX vaults hit critical lows, when Dubai trades $30 over New York, the kill switch becomes irrelevant because the paper market loses credibility. Here's the intelligence assessment. 3 scenarios. Scenario 1, paper market collapse. COMEX and LBMA shift to cash settlements. Physical delivery becomes impossible. Price discovery moves to Shanghai in physical markets. Western futures become financial instruments disconnected from real metal. Silver revalues based on physical supply demand. $300 plus becomes baseline. Scenario 2, regulatory intervention. Expands. CME implements position limits, trading restrictions, forced liquidation protocols. Government designates silver as strategic commodity. Export controls from producing nations. Centralized allocation systems. Price controls attempted, but fail due to black market premiums. Scenario 3, managed squeeze. Bullion banks slowly cover shorts. Physical premiums widen gradually. Paper prices rise to meet physical. Volatility persists, but system doesn't break. Silver reaches 150 to 200 over 18 to 24 months. Which scenario is most likely? Hybrid. Elements of all three. The paper market is already showing cracks. Backwardation, vault drains, premiums spiking. Regulatory intervention is intensifying. Margin hikes, position limit discussions, and physical shortages worsening. China restrictions, industrial demand, investment flows. The math points to one conclusion: silver is being revalued from industrial commodity to strategic resource to monetary alternative. The 30-year suppression is ending, not by choice, by necessity, because the physical market is taking control. December 29th, 2025 wasn't a crash, it was a transfer. Western paper holders sold to Eastern physical buyers. Leveraged speculators got flushed. Bullion banks got temporary relief. But the fundamentals didn't change. The deficit is still 300 million ounces. China still controls 70% of refining. COMEX vaults are still bleeding. Industrial demand is still rising. And more investors are waking up to the divergence between paper promises and physical reality. The kill switch bought time, weeks, maybe months. But it can't stop what's coming. Because when 356 paper claims compete for 1 real ounce, someone doesn't get paid. And when that happens, price goes to whatever clears the market. The CME in Shanghai didn't freeze the silver market. They revealed it. 2 systems, one dying, one being born. Choose wisely.